trend now, and you do that same pyramiding up, and now you get into that trending period, you're going to be guaranteed that you're trading your largest when you're trading your best. And that's the job of it. But there's a price to be paid. And in a whipsaw market, yeah, it's going to be frustrating. This is why people say, why isn't everybody doing this? Because it's not that easy. It's really difficult. It's difficult. First of all, you got to have the knowledge. You got to develop the skill. You've got to be able to control your emotions and have discipline and deal with all these things that are counterintuitive, and then deal with these long periods of time where it seems like it doesn't work. But you have to, after a while, you learn that that's part of it, that not working, all that boringness. Trading is boring. 90% of the time, it's very boring. You don't want the hair on the back of your neck to stand up when you're trading. Did you see how calm all the trades I just did? Like, there's no big emotion. I put on the trades. I know exactly where I'm getting out. I know my position size. I bought $600,000 worth of stock today. If I bought $10 million in a position today, there would be the same exact emotions. There would be none. It would be emotionless, because I would already have my risk defined. I've got a plan, and that's the way it needs to be. I'm not looking to get excitement. I'm not. This isn't for. I want to get excitement. I go drive my Lamborghini and go race around a track. That's for excitement. When I go to Vegas and roll dice and have fun. This is about performance. And if you want excitement from it, that's fine. You can get it. They'll give you a lot of excitement if you want it. But that's not, you're trying to develop this into an unemotional, very systematic, methodical strategy that achieves the goal of putting you in a position to make lots of money when you're right and minimize when you're wrong and create asymmetric leverage always. Mark, you have anything to add to that? And once again, this zigging and zagging, this is the most common thing we hear. Well, I ramped it up and then clobbered. And then when I trade small, then the stocks take off, and this progressive exposure isn't working. It's working perfectly. That's exactly what it's supposed to do, right?
Yeah, it's like it's a feature, not a bug. What was just described there, the idea though is, if there will be plenty of times where you're going to jockey for position only to get out, with a tiny gain, right around break even. But if you were able to, increase your exposure without taking additional risk, do it properly. Just think about how many times you could do that, and then you really nail the timing one time. It will more than pay for all those other times, and that is very difficult though for some folks psychologically. Especially, well, I had a couple of winners and then I gave it all away. Well, the idea wasn't to make a little bit; it was to be able to position yourself properly with a small initial risk to make a giant step forward in terms of your P&L.
Hey, another thing. So let me show you. This is what when you're trading stocks, you're trading stocks that look like this, basically, right? They look like this. That's what your equity curve should look like. See, so when you're in that phase where you're getting whipped around, this is what happens right here. Yeah, and this may go on for 6 months, a year, right? But you see, the one thing that's happening here is I'm not losing any major ground. Yes, a lot of frustration in here, but not much ground being lost. And even if it was maybe, was down a little bit and you are getting grinded away a bit, still you're minimizing and putting yourself in a position for the big move and being fully invested when things are working. Just like a stock, your equity. If you were to look at Mark Ritchie's equity curve, look at my equity curve, you go through basing periods and then sharp up moves, and then basing periods and sharp up moves. And very seldom are there any big drops. And if there are big drops, and matter of fact, I looked at your equity curve, and whenever Mark Ritchie's equity curve had a big drop, it flatlined, which showed that as soon as he got under pressure, bang, he went to cash. And then it just flatlined, and then it slowly moved back, and then it accelerated. It was perfect. You could actually see the progressive exposure in the equity curve. I could look at somebody's equity curve. You show me your trading, show me your equity curve, and I'll tell you everything about the trader. Matter of fact, Mark, you remember that's us, but you didn't tell that story.
I didn't know. Yeah, I thought that one was maybe overplayed in years past, but I'll have to tell it again. So, in the very, actually, it was after the first Master Trader program, because I had sent Mark I think it was 6 months of trading or something to win the triple digit challenge. And he did a webinar, I don't know, a few months later. And we didn't really know, we shaken hands in person and said hello. That was about it. And so, sorry about that. He started to describe me in what I felt was rather, somewhat personal manner in terms of my personality and certain characteristics and who I am. And they were all accurate descriptions, so much so that my partner Brandon was like, how in the world does he know that stuff? It was a little bit eerie, almost like somebody was, reading your palm or whatever. So then when we were together a number of months later for the next Master Trader program, I just brought that up. I said, that was kind of a fun trick you played there. How did you know all that about me? And he said, I've looked at all your buys and sells. Your trading is nothing but a reflection of who you are and your personality. It's all there. So, and I can't remember the comments he made specifically, but he's like, I can tell Mark Ritchie is not, he's very disciplined and he's not very emotional in terms of his trading. He said a few other things, but the idea being that your psychology and who you are is reflected in terms of the way you buy and sell in real time.
Yeah, if I look at an equity curve, I mean, I've trained thousands and thousands of traders. I've worked with thousands of people over the years, over 40 years, have had hundreds work for me. And I can look at an equity curve. I can look at someone's trading, and just like with aces, I can't tell you if you're going to win in any particular hand, but I can tell you, aces are going to win over. It's a winning hand. I can look at an equity curve and know this trader is a losing trader. This trader is going to blow up. This trader is doing everything right and is going to be a superstar. I know what a superstar equity curve looks like. You give me, maybe not in a month or two, but show me years of trading of somebody trading, and I'll tell you, I'll foretell the future because it's all right there. And it all comes down to managing the risk versus reward. So it's the exact same thing as what you're trying to accomplish with the stock. There's the same principle. You're putting yourself in a position to have this upside by capping the downside and creating the asymmetric leverage. All right, let's we're supposed to do questions on the workbook here, and we got stuck on progressive exposure for quite a while.
Yeah, well, there was a lot of questions on that.
Yeah, I know it's a huge topic and everybody asked, so it's good that we did, but let's move on.
And then there was a related question to what you just described. I'll just ask while I'm getting the questions on the pages, specific pages, but and now I just lost it. All right, I'll come back to that. Bear with me. 454.
Hold on 1 second. I just have to 454, did you say?
Yeah.
Gotcha.
Question was being asked if you can just review again how you're adding more shares, but with the same amount of risk.
Okay, so again, when you take your first position here, obviously it's all risk. You're risking $1,000. You're risking $1 on 1,000 shares, so you're risking $1,000 is your risk, right? As the stock moves up, and we're just going to call this a low cheat or a cheat, and then you form another pivot within the base. You get another buy point. As you add shares here and you move your stop up, the new stop becomes a backstop. It actually becomes a trailing stop on your profit and a stop loss on your new shares. So now at 1850, you add 1,000 shares, right? So you have 2,000 shares now. So you have $1.50 stop at $17 on 2,000 shares. But you net this all out, the profit that you have and the risk that you're taking, and you're still risking $1,000. If you get stopped out, your net loss is $1,000. But you now have 2,000 shares on. So if the stock goes up from there, you are now levering up. Your upside is double, but your downside is still the original $1,000 risk.
One question was asking on 430, you don't have to pull that up, but on the tracker spreadsheet is asking how you accommodate or adjust for, half size positions versus full size positions, because this does not take into account weighting of your trades.
Yeah, that's a common question too. I don't weight them because this, I look at it this way. This is when you look at your largest gain, your largest loss, you look at your average loss to gain. That's your decision making based on where to get out, where the chart sours and the mathematics behind it, risk reward. Position sizing, yes, is another aspect of it. And obviously, if you were taking big positions on the big gains and small positions on the on the smaller gains or vice versa, that would affect things. What I've found, and I used to track it and weight it. I know Mark does weight it. He does weight his results, and when he analyzes the results, he weights them. I weighted them for years, and I found that it kind of comes out in the wash, and it's just more pure to see the decision making versus the weight. Now, the weighting, if you want to do a separate table and say, okay, well, I want to see if I'm making good decisions on, position sizing. Well, again, like the previous person said, in a whipsaw market, that's going to look bad. In a good market, it's going to look great. Because now the positions that are big are going to be your big winners. So it depends on the environment, whether that's going to bear out and look like it's working or not. So you have to know that. So everything comes out in the wash pretty much. Sometimes I'm going to have the bigger positions and a better name. Sometimes I'm not. But I found that it really comes around an average, and I've never seen it to give at any value to track it that way. So I stopped tracking it that way personally. We do not have that in our own tracking. We do not have that. We'll probably at some point add that feature where you can put position sizing in and then get that net result, sort of like the adjusted win-loss ratio, adjust for position sizing. We will add that, and we are now working very quickly. For those of you who are members and have used our software, we're right now working furiously on Monolith. And once we get Monolith to a certain point with charting and a lot of really cool features, we're then going to improve trading logger, and then they're going to be tethered together even in a more impressive way, where then they all work together. We're going to have a lot of ways to slice and dice the information. So we're going to have a big leap in the technology over the next 6 months of this next year in 2023. But I personally don't use it. Even when that capability, I probably won't utilize it.
Question on 469.
469, yep.
As you increase your exposure, do you still keep overall risk to a total of 1.25% to 2.5% of your total equity? Do you keep risk to total equity even at 100% invested? Not sure why one would make a difference.
Risk of total equity is on your
Per trade.
position at each position.
Yeah, maybe that's the problem. They're not understanding that's per
Right.
position.
Right.
Yeah.
It's on your position. So if you were to take a 12.5% position, if you have a 10% stop, well, that's 1.25% of total equity, 12.5 divided by 10. If you were to take a 50% position, well, that 10% stop would be 5% of total equity. So you wouldn't be able to do that. So you'd have to cut to maintain that 1.25, you'd have to take your stop all the way to 2.5%. So either your stop has to move or your position size has to move. They work together in creating your risk of total equity. So then your total exposure, that's based on how many positions you put on, but you're still, if you have a certain risk of total equity, well, that's your risk of total equity. You understand? That's each individual trade is what you're basing it on, though. Because this is to help you with the risk of ruin if you get stopped out of a bunch of stocks. So that's why on each individual stock, you only want to be risking X amount of your total equity. So it has a certain level of impact on your overall portfolio. Too little of impact, you won't make any money. Yeah, you won't lose any money, but you won't make much money. Too much, you can make lots of money, but the risk of ruin, if you get a streak and you happen to have 10 trades, 20 trades that are bad, or maybe your batting average goes down to 20%, the last 20 trades, you're only right 4 or 5 times, you can blow yourself up because now you're risking too much. There is an optimal level. And that 1.25 to 1.5 is sort of a sweet spot. 2.5 is the upper end. Anything below, you start getting, below 1 or 0.75%. Now you're getting into pilot buys, and that's, that's not where you want to be optimally when things are working.
Page 494.
Yep.
Just a quick answer. The question was being, if they were just using the 8% at 13, not compounding. So that answer, guys, is when you do a compounding. So if you have a 2%, 25% position sizing, 8% return equals 2% on your portfolio, but your portfolio is growing with each successive winner, that's what will get you to the 30%, not just a straight line using the same original starting amount. So
A
Norman.
25% position times 8%, 13 times compounded is 30%.
Yeah, so that's what that is. Norman also was just asking if you can try to explain again the concept of the saving bets can be a game changer from the mind blowing math.
The saving bets, yeah.
On page
we have a
501.
line. We have a line
Or-
through here because there was a typo. We talked about this last night, Bob.
Oh yeah, let's
yeah.
clarify
So
that.
this actually should be 2040, right? That's
Right.
2060 is 2%. It's supposed to be 1% more. But the concept of saving bets is very simple. Again, if you're breaking rules, this is just showing that if you're buying beyond the buy point, and let's say I'm saying where I'm not going to buy more than 1%. Okay. So we're still going to stick to the same sell rules. We're not going to change our sell rule, whether we bought it 1% above the buy or 2% of the buy. Doesn't really affect the sell rules. So let's just say we sell at 6%. Well, one trader buys it at 2020, sells it at 2120. The other one buys it at, in this case, 2060. 2040 is the math, though. 2040, which is 1% higher. Okay, it doesn't sound like much. It's just a 1% slippage. But now do that hundreds of times, and it's a colossal difference because that adds up. All those little. Now that's just on the buy side. What if you have slippage on the sell side, and you start breaking these little, because it's a slippery slope. Once you start breaking rules, you break more rules, and before you know it, you don't have many rules, and catastrophe strikes. So the whole point of this is to point out that the little things, as Mark said, it's the little things that add up because it's over time. It's just like an airplane. If you take a plane, a jet that goes from New York to LA, and you just put it off just 1 degree, well, in a very short period of time, it goes pretty much on its course. But over a long stretch, it'll be up in British Columbia. It'll be up in Canada, because and same thing with a bullet. You shoot a bullet, if it's off a little bit, the further you go, the further it goes away. So these things add up over time, and that's why you have to think that you're not going to just make one trade. You're going to make lots of trades. So these numbers are going to distribute over a bell curve, and that tightening all this stuff up and having a really, really tight game creates the champion results.
Question being asked: if a stock had historical a lot of volatility, even though it is setting up properly in a VCP now, does that affect your decision to trade that name, being that it has had historical volatility in it?
That is about as vague and hypothetical as we can get. So I really can't. I'd have to see the chart. Look, the bottom line is the chart tells it all. If it has the chart and the chart meets the criteria, well, that would assess that volatility. Assessing the volatility that's why you have a chart. The reason why you're looking at charts is to assess the volatility and lack of volatility. So you got to look at the chart. If the stock's in an uptrend, see, don't overcomplicate this. All right. Stop trying to get all these answers and just focus on what to do. Don't worry about what not to do. There's 100 million things not to do. There's a handful of things that you need to do. You know what you need to do? You need to look for stocks and uptrends, look for bases, VCPs, tight right sides, single digit tight right sides. And when they get above that pivot point, buy them. Take small positions. When things start working, raise your exposure and do the opposite on the downside. That's what you need to do. That's it. Now that could take a lifetime to become as good as me at doing that, but that's what you need to do. It's simple, it's straightforward. Is it easy? No, but there is no magic answer. Those are the things that you need to do well.
Okay.
All that takes care of everything else. That takes care of everything. Takes care of the valuation. Takes care of everything. It's all going to work out. You know, it manage that risk versus you're going to be in, as Paul Tudor Jones said. I'm gonna buy stocks to go to zero and sell stocks to go to infinity. There is so much wisdom in that statement that backdoors the Holy Grail, because what he's saying is that there's this much upside, there's downside to zero, but it's you cutting the middle and managing the downside to the upside. You don't need infinity. You just need more upside than downside. And you need to be able to do it enough times to get to your goal. And the upside is going to set as the pace car, and that's going to set to tell you where you need the downside to be. The percentage of winning, the average gain, and the percentage of times that average gain is going to come to fruition. Once you get an idea of that, you don't even have to know exactly. If you have a good idea that I'm going to have 10, 12% on the upside, and I'm going to write 40 or 50%, the downside is a mathematical calculation now. There's an optimal number. It just becomes a simple mathematical calculation. Now you take that risk factor and you back into trades. You back into trades that fit that risk profile. That's the whole thing. That's the whole thing in a nutshell. Those who understand that and are able to crystallize that and to put that into practice, like Mark Ritchie has, become very, very wealthy from this process. Those who don't end up usually giving more money to the market.
Questions, Mark, just not on a page number, but I have had a number of people who are with full-time jobs, not able to look at the market and watch the market throughout the day. And even people from, Australia and such, where they would be sleeping when the market's open. What would be your recommendation for them as far as placing stop loss orders with brokers, buy stop limit orders to make sure they're not chasing gaps and things like that?
You're just going to have to use the technology to be able to, Mark, do you have any suggestions for that? I think you know more about the platform and the parameters. I'm sitting in front of the screen, and so are you all day, and we don't have that issue. But I don't know. Do you have any suggestions for that?
Yeah, I would say, for starters, you probably want to focus on a little less activity in general, right? Because you're not sitting there in front of things. So I would say that tends to be a little bit more lending itself to swing trading, or even swing trading and then playing names for a bigger move versus the shorter term trading and that type of thing. But I would use some type of stop limit in terms of for entries, not for exits. I wouldn't do that. But if I wasn't going to be around and I wanted to make sure I'm filled within 1% of a pivot, I would have it triggered and then only fill up to the point I want to. That way, if it gaps above me or through me, I'm not breaking discipline. As far as getting out, I would not use stop limits because I want out. So yeah, I will take
right back. I gotta go for 1 second. You guys continue.
I'll take the slippage on an exit to ensure that I'm out, but on an entry, I would be a little more stringent.
Yeah, I think that question actually was asked by more than one person. So when stops are triggered, guys, you want to be out. And if you have a limit order where you're saying I want to sell, if it triggers this price, but only to this amount, what happens if the stock blows right past it and just goes down, 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 down? The quick or the old cliche is your best loss is the quickest loss, right, Mark? or your first loss, and getting out and recovering and being able to get back to focus on that is going to save you way more time and energy than the idea that you may be trying to save, but is just a few difference of sometimes pennies that prevent you from being able to get out, even if it's more than 10%. It's one trade out of what might be hundreds or thousands of trades. As Mark mentioned in his 40-year career, it does not happen all that often, but when it happens, of course, it's going to sting, but it's just one trade out of many, many, many that you'll be experiencing. Let's see if I can get a couple questions that won't be page specific. So without Mark there. Bear with me. I got to get to a different list here. Can Mark Ritchie discuss having his specific techniques for re-entering all or part of positions when he is jockeying for a position and reduced either on a squad or close below the 20 period moving average? That's the detail I always struggle with, where reducing risk, the worst case often is the right move, but lack the ability to re-enter or add back to the reduced portion when the original stop was never hit.
Good question, and there's nothing different than we just presented. Meaning, so I'm looking for some type of, failure reset, like we discussed, or improvement in the pivot. Like Mark's ALNY is a good example from today. The stock squats, you can decide to sell it. You don't have to. These are the decisions you generally want to make beforehand as well, guys. So that removing those degrees of freedom on the fly will, in my opinion, will help you make better decisions in real time. But there are plenty of times if you're going to be jockeying for a position and I decide to cut a name, it might turn around. And this is the whole point of the Hardaway crossover. Sometimes the name leaves you in the dust. There's not always, a re-entry possible. The key is to have a plan. To know what you want to see in order to get back in. So sometimes I might step aside. Let's say the name just pokes its head out and then pulls right back into the range. And I don't like the way say the action in that stock and other trading, I might cut part of the position, but then set an alarm at that high saying, I'm going to re-enter the position if things turn back around, or I want to be alerted to the possibility of re-entering the position. So that's kind of how I do things, but I'm always looking is there a plan for re-entry? And in most instances, if I'm cutting something off before a stop, it's always either because the train didn't come in on schedule, so to speak, or my overall trading is not going very well.
Real quick too, I always say you can't kiss all the girls. There's going to be a lot the stocks that take off and blast off, and a lot more stocks are going to go up and make big gains without giving you buy points. But again, that's the upside. The downside is what you got to concern yourself with. You got to put yourself in that position to have that happen on occasion. But the downside is what you have to be concerned with, not the upside.
On that note, I'm going to grab some lunch here.
Go right ahead.
This is a question that also was asked a few times in markets, a concept that I will admit and acknowledge took me years from tutelage from Mark to understand. And now that I get it, it's so obvious, but I know a lot of people may be struggling with understanding the benefit of selling into strength. And Mark Ritchie, who just stepped out, made a comment back on page 379 during the presentation.
Yeah.
And the question was, what does the benefit of the equity curve smoothing do for you? Because the example here was you were selling into that, gap or move up into the 24-25 area. And Mark Ritchie made a comment, he would be selling into probably that 22. The first gap
on the right slide. First of all, there's no 24-25. What are you talking about?
379.
Okay, I was going to say we're definitely on the right slide here.
Yeah, you're right about that.
Hold on, 379.
Yeah.
Yeah. So go ahead.
So Mark Ritchie made a comment that he would be selling into that gap up around 22. And the comment was the person's asking why, and it did continue higher to 25, and why not just let it see if it could go higher and then have it your backstop at 22 at that point? What would be the difference or the benefit of selling into that strength of 22 instead of waiting for it to come back to 22?
You don't have the benefit of hindsight. You don't know it's going to go up the next day, first of all.
Right.
It's easy to say now that you see what it did. So I don't understand. I don't understand the question of the comment.
Yeah,
it's getting climactic. So we're getting out when the getting's good. You don't know when it's going to break. So you've gotten the 8 out of 9 days up. You got some a gap or two. You got the largest uptake. Okay, you didn't have maybe you didn't have the widest spread at that point, but you still, it was up. It was accelerating. So you and I wouldn't even sell all of it necessarily. This is where you start scaling out. As it goes up, you scale out, and then you maybe backstop the rest, or you sell part of it. So you certainly could, do a partial. But you don't have the benefit of hindsight. And it's not about getting perfect, of getting out at that exact high. It's about making more than you risk. You guys got to understand that this getting the highs, getting the lows, getting it perfect, that's not what it's about. It's about the general vicinity of where the stock is now. The risk outweighs the reward. And now the risk of it coming in and giving back all your profit, like this stock came back in, from 25 or so back down to 18 change, is increasing, and you've accomplished your goal. You've accomplished your goal. Look, if you want to play for a bigger move, you can put a backstop and you can hold it. You don't have to sell it. It's all based on your plan and what your goal is. You have to have a goal and a plan. Some people, they want to trade their way to the big return and minimize that drawdown, so they're selling at the strength and taking the short-term moves. There's other people that want to have a more passive style, and they're going for the bigger moves. Well, you're going to have a lot of times where you're going to give back profits, and you're going to have to go through that to get to that. Everything has a price. It all has a price, but you have to keep your eye on the not just the prize, but the process and the goal. What is your goal? Your goal is to make more than you risk, and to do it as many times as you can. It wouldn't matter. Let's just say I bought the stock right here and sold it 2-3 days later. If I can do this X amount, if I can cut off the downside in relation to this upside, right? This little tiny microcosm of all this price action, this is where I operate. This is my whole operation, is in these little short-term moves. Well, if I can reliably get this on average, let's just call it 10%, and I can keep the downside to 5%, and I can do it 40 or 50% of the time, I make a fortune. See, because that's what it's about. It's not about looking back and saying, oh, well, I want to sell at that high or buy at this low. And that's what people get into. Everybody wants to buy Facebook now at the low. They want to bottom fish to Facebook. They look at how high it was. Oh my God, it's down 75%. How much lower can it go? 100%.
Mark, I think we did.
I know I'm going on a tangent, and I know I'm going off things here, but I want to make sure I keep you on what's important. But go ahead.
Yeah, I think we did a study that showed for the trailing stop, it was something along the lines of 10 to 25% is what you give back of that profit that would have been taken had you just taken it, into the strength originally. So you may want to do your own study to see, as you learn better how to sell into strength, how much are you giving back when you do that trailing stop? Because by definition, it has to be lower.
But it goes even more beyond that. There's things that, again, my karate teacher used to tell me when I started thinking I got it down, and he'd say, I taught you everything you know, but not everything I know. So there's more to it. All right. There's even more to it, because when you have a situation like this, all right, and let's just say you're using a moving average, right? All right, let's do this. Okay. So now here's the moving average. All right. Here's the moving average. All right. And now you use a trailing stop. You use the moving average. Well, over here, the distance is from here to here, right? You've got this distance, right? So that's your give back. But when you accelerate, and you have these accelerated moves, well, now look what happens. Look at the distance between the moving average, because the price accelerates way away from your trailing stop. And now, in order to get that sell signal, you've got to give back a giant portion. So what Bob is trying to say is that when you sell into strength, what you save, okay, if you use a trailing stop, or you let the stock go to a point where it's obvious, it has to break so much that you give back so much, it's not worth it. The other thing too is that when they like a plane that goes straight up, or a rocket, then when it stalls, it comes straight down. These stocks, when they get up like this and they get so extended, and you get all these sell rules start kicking in, they break hard and fast. This is when they can come in super, super fast. So these are all the elements that have to be taken in consideration. But you'd be better off if you just trust me and you put this stuff that you'd be better off than trying to figure it all out. I figured it all out, and O'Neill figured it all out. And guys like Mark Ritchie came in and said, you know what, instead of me trying to rebuild this whole thing, maybe I'll just do what Minervini's doing and then learn it and get some expertise and then start, and then what happened, Mark, after you did it for so long, you realized you didn't have to figure anything else out new, right?
No, the wheel was still working just fine. Put it that way.
The wheel was, the round wheel, was the best wheel. There was no other way to make a circle. So again, and then what'll happen is, once you get to the point where you've got the expertise using these techniques, the subtleties that I'm talking about, you will start to experience yourself, and you'll know all these things. Because one thing that you can't do is you can't force experience. No matter how much I give you, I could give this workbook could be 10,000 pages, and we could do this for the next 3 months every day, and you will never get to my level in that amount of time. It's impossible, because I have 40 years of experience. Okay.
You hear me? The potato chips. Sorry.
You're on. Your mic is on.
Turn the camera off, not the mic.
Yes, I know. It's like the time we were at the live event in person, and I went to the bathroom and left the mic on, and everybody heard everything. And I came back in, and everybody was laughing. We actually did that a couple of times. Bob did it once.
Yeah, I was first.
You were the first one to do it. So you will learn all these things over time, but in the beginning, there's certain things that you're just going to have to use some guidelines and get there and put in the time. That's why if you don't build proximity to your goal, mental proximity, as you're utilizing these techniques and strategies. And if you're not doing well, realize that you are getting closer. You're getting closer to being proficient at this, even though it may not feel it, and you're going backwards, and you're losing money, and things aren't working, and it's 2 years go by, and I can't seem to make this work. It's the guy who says, you know what, 2 years have gone by, I must be getting closer because I've got all this time, I've got this knowledge under my belt, versus the person who says, I just wasted 2 years of my life. That's how everybody always asks me, how did you make it through those 6 years where you didn't make any money? Because after the first year, I said, wow, I got a year under my belt, I must be getting close. Then 2 years went by, and I went, well, I'm a year closer, so it's got to be right around the corner. At 3 years and 4 years, I went, man, it's got to be any day now. The longer it went, the more I felt I was closer, as opposed to saying, oh my God, I just wasted 6 years of my life. This doesn't work. Why am I doing this? Pounding my head against the wall. That's the way a loser thinks. A winner builds proximity to their goal. They stay the course. They make a commitment, and they keep going. And they're tenacious to get to that goal, but building mental proximity. So my point is, and I know I'm going way off here, but because these rules, there's a lot of things that you can't see, that you don't understand, that you may think you understand. It may seem obvious, but you don't until you get in there and you make these trades. You got to make trades. You want to play the piano? I played the drums for 50. I started playing the drums when I was 6 years old. I'm 57 now. I've been playing the drums for 50 years. You know what? You got to play the drums. You got to go in there. I had to go in there and play the drums, and play and make mistakes and learn. And over the years, that experience, you can't force it. You just can't force. You have the best instructor. You have got the best. You can have sheet music in front of you. You can have the best band. Doesn't matter. You can't force the experience. Get in there and make trades with real money, and make the trades. And that's how you'll learn, and you'll get these answers.
I'll just add too, Mark, I think, because one of the things I remember taking away, it's in my first notebook somewhere. And for those of you guys who want it, here's a stack of some of those notebooks right there. But of old workbooks. Mark said most traders overestimate what they can do in 2 years and underestimate what they can do in 10. And I put that in my books. Like, this isn't a 1-2 year, ride. I'm playing
10.
Yeah. And that has definitely been true. I thought I was going to make $1 million the first year or two. It took me longer. But if you'd told me then, that I'd be where I am now, I would have said, yeah, I think I'll take it. But the idea was you had to have a longer term perspective, in mind. And expertise. I continue to get better at this. People, oh, how long did it take you to figure it out? I usually answer, I'm still figuring it out. I feel like I'm getting better all the time. So viewing it as a process, not that you're going to hit your destination in, a few months after this program or whatever.
Yeah. And I definitely am not, I'm never going to peak. Like I'm never going to be where I'm